welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as usual with Erik, Olson, and Adrian Nicholson, and we have an important topic for you today. We're going to talk about the real estate market. What's going on? Is it a buyer versus seller's market? What are some important data points, and what can you do about it? This is a really important one because your home purchase is typically the biggest purchase that you ever make. So making sure you plan it out well with all the different factors that affects the price and making sure it's a good decision for you at the time will really help you achieve higher net worth and better wealth along the way. In addition to that, if you're looking at it as an investor, we've got some important pieces of data for you and important information that can help you decide whether to buy that investment property or not. Now, how part of the reason this topic is top of mind for us is not only are we just seeing what's going on with real estate, but Erik, you are in the middle of two real estate transactions right now. So tell us a little bit about your experience. What's going on, both on the personal level and with some of the data. How's the move going?
Well, it's that's right. So we bought a home in Michigan, and we closed on that about 10 days ago. And then we also are selling our home in Illinois, and we close on that in about a week. So the two together, we've seen the impact of this environment on the price of both what we paid for the home in Michigan and also what we received for the home in Illinois. And it's been a dramatic increase on both sides of that transaction from what it would have been had we done this 1 year ago. So that got me thinking about some of my clients who are also looking at their financial situation, some of whom are contemplating a move or have been. And so I thought it would be interesting for us to share with our listeners some of what's taking place out there and how to think about that. So if you're someone who's contemplated buying or selling or both, as I am doing, then this a little bit more informed perspective may help with your approach to one or both of those transactions.
Yeah, very much so. And I think a lot of where you start with this, with do you want to be a buyer or seller, or the term that'll be used in real estate, is it a buyer's market or a seller's market? So
Mm-hmm.
right now, it looks like a seller's market is defined by demand exceeding supply. This seems like an extreme seller's market based on some of the numbers and the data. But Erik, in your experience on the side of selling, did your home just move very quickly?
Right. So we listed one day. We had five people request to see it the following day. By the end of that day, 3 of the 5 had made an offer, all of them above the ask. And with escalation clauses looking to outdo one another. In one case, the escalation was raising it by up to 8% above what we were asking. So people, every one of these buyers understood they're not probably going to win if all they were doing was offering what we asked.
Yeah. And then on the other side, when you were the buyer on that transaction, did you find that you were in a competitive situation, the multiple offers, escalations, and so on, as you had on the other side?
Right. So we had an escalation in ours as well. We offered what they were asking, and we added 3% effectively to that. And the seller in this case, wonderful people. I'm not faulting them for this, but that they said, look, we don't have a written offer that pushes you all the way to the top of your escalation zone, but we're prepared to pull it off the market and relist it at a higher price, because we've seen through the experience of how many people expressed interest in this home. So suddenly we now believe that we erred in how we priced it initially. And so we want to drive it higher. Bear in mind, though, that the price that they set was about 10% already above what they would have sold it for roughly a year ago.
So
And So it was right off the bat, it was well above where it formerly had been, and we drove it higher still. That same dynamic, though, worked for us on the sales side, in that we were probably 23%, we sold for roughly 23% more than we expected we would sell had we done this a year ago. So we lost and we won on depending on which side of the transaction. The net for us was a win. I mean, we were able to receive more in percentage gains than we had to pay in percentage gains, and so it worked out in our favor.
Wow,
So
that's incredible, Eric, and it really shows how strong demand is right now in the housing market compared to 2008, which was mostly fueled financially. Now it's more of demand where sellers and buyers are being connected more than ever right now. So it's a big factor to really look at, and something new now in the housing market where people are searching for homes and prices are increasing. So it's a really new thing to look at. That's really interesting.
yeah,
Right.
I got to ask you a question, Eric. And I have to, because I've never heard this before. So that seller came to you and said, "You're the high. I'm going to give fake numbers to it. You're offering us 100 grand, but your escalation's up to 110. I don't have an offer for 110, but you better pay me that, or I'm going to go back, take it off the market and go back on." Is that
Right.
essentially what
That's
they did?
exactly right. And our agent, who is our buyer's
Wow.
agent, was saying, "Wow,
Yeah.
that's not really playing by the rules, but it's their property and they're free to do whatever they wish to do. It doesn't look great to prospective next buyers if it was pulled and then immediately relisted at a higher level. But hey, it's a free country. They can do what they want to do. So Eric and your wife, the two of you want to play a strategic game here and let them relist and see what happens and make the same offer, or do you want to just go for it and get this over with?" And we chose the latter.
Okay, so the first thing that I'd say on that, one, I'm not surprised your realtor said that's not playing by the rules, because I I've never heard of that happening. I didn't even think that was a thing. But second, it really does speak to the strength of the real estate market right now as a seller, right? The fact, not only is it a seller's market, but it's an extreme seller's market if they can just say, offer us more because you said you would in your contract, and we'll just go back to market because we can get more, right? Yeah, that's
Right.
pretty.
You tipped your hand that you're willing to pay this much. Now we know that you're willing to pay this much, and so we want what you're willing to pay. And so, well, they got us there. That's absolutely right. We did tip our hand.
And as a I mean, I don't think you made a mistake because you're preparing for a competitive offer, and you've got to go in and say, "I want this escalation," right? I'm willing to pay a little bit more to beat the next offer. So I don't. Yes, you tipped your hand, but you didn't know what else was out there. So I get it. Some other numbers and data just behind this seller's market that I found interesting.
Mhm.
Uh, and I've seen similar things, Eric, to you. Our neighbor that lives right across, I can see them from their house from my window. Their
Mhm.
place sold in a weekend. It sold, I think it was above ask as well. So everything I'm hearing anecdotally lines up with what you're seeing. Another thing that's interesting to me in your story, though, is oftentimes we're looking at national numbers and national statistics, but
Mhm.
your purchase and sale they're in the Midwest, but they're in two totally different areas.
Right. So
Right.
the
So how
first is
far
here in
are they?
northern Illinois, and the other's in southwest Michigan.
How far by mileage or drive time?
A little more than 200 miles.
So 200 miles. So they're definitely different markets. Like you always
Yes.
hear about how real estate is local. And we talk about national statistics. You're buying in one market, selling in the other, and you're having the same experience as far as it being a strong seller's market.
Right. So we're close. If you're familiar with the notion of a metropolitan statistical area, or an MSA,
Yeah.
we're somewhere in relationship to either the Rockford MSA, Rockford, Illinois MSA, or the Aurora, Naperville, Elgin MSA, or the Chicago MSA. So all three of those MSAs have some sort of bearing on our setting, and then in their case, there's both a Grand Rapids MSA and a Holland MSA. And so they're very close to the Holland MSA. And so, yeah, and those are the sort of data points in terms of looking at what's going on in those different MSAs.
Okay. Some more numbers on this, though. And once again, this is national,
Mm-hmm.
but at one point, inventory was down over 32% over the previous year. At September, inventory was down 28% from last year. So supply's low,
Right.
and interest rates being as low as they are helping fuel the increased demand and higher prices. Another number, the median sales price is about 320,000 nationally for a home. That's up 14% from last year.
Okay, so I have similar. Are your October numbers? Is that what you've got?
Yes.
Okay, I have some November numbers as well. These are from
Okay.
Realtor.com, and they have a sort of a research component as well. So what they're saying is the percentage increase is very close to what you said. They're saying the median price now is 348, up
Wow.
13% year on year. So from November to November,
Mm-hmm.
the number of active listings is down, as you said. It's whopping. It's 39% decline of listings year on year. So you're talking about a massive contraction on the supply. And at the very same moment that interest rates are driving people to say, hey, maybe this is time to get out there and buy something. So but there was one other interesting number that I thought was so shocking, actually, and that was the number of months supply of housing right now.
Yes.
So that number is down to 3.3 months, which is about as low as it gets. In fact, I'm going to share my screen for those people that are looking on YouTube for this, so you can see just exactly what we're talking about here. This is just amazing to me. So look at this graph, guys. Can you see this? So what you're seeing is this is going back to the early 60s, and the number of months supply in the US had been as high as slightly above 12 when we had the financial crisis in 2008 and running into 2009.
Mm-hmm.
It went as high as slightly more than 12 months, and it kind of worked its way back by 2013, so that it was as low as 4 months. During the late 1990s, early 2000s, when everybody was going wild for housing. I mean, you remember that part, especially the housing bubble that culminates in about 2006 or thereabouts. It had also reached a very, very low level of 3.5. That was it. But right now, far right margin for the October number, there's not a November number that's been produced by this. It's at 3.3. And so, by the way, for our data-driven people who are interested in this sort of thing, you can see on YouTube if you're watching, but if you're just listening, the Federal Reserve, the St. Louis Federal Reserve, has an incredible website with all sorts of data about this. So this particular graph is under the monthly supply of houses in the United States. And so we'll supply a link to this graph, but isn't that just, can you see on the far right, guys, how it drops off like a cliff?
Yes.
Yeah, it is surprising how sharp and how quickly that move went down, but that just really, you can see over time, you look at the whole graph, just how sharp the housing market can really be when these shifts. And it just ultimately shows again how strong demand is and how low supply is, which is really the overall theme for the housing market right now.
Right.
Yeah. And added on to this, we're talking about low supply. So low supply means prices go up. And we mentioned interest rates. We're at last year, the average interest rate paid on a mortgage was 4.25%. Right. Right now, you've got people getting their 30-year mortgages at right around 2.5%. right? So it's not quite a 2% drop, or looked at it from another perspective, it's not too far from a 2% drop, or almost cutting in half the interest rate. So that chart you showed for housing supply, if we overlaid that with interest rates, you would see a similar decline. So there are actually two pretty big factors driving prices up and making it a seller's market. And just giving you a quick number on this, if you bought a house for $240,000, and then you put 20% down, so your loan is $192,000 at 4.5%. Your payment is $972. If that interest rate is 6.5%, I know it's higher, but it illustrates the swing up. If it's the 2% differential, if it's 6.5, you're to get the same mortgage payment, instead of taking a loan out of $192 on a $240,000 home, you're taking out a loan of $153 on a $192,000 home. So that's a $40,000 difference in your mortgage, a little more than a $40,000 difference in your purchase price. But in percentage basis, a $40,000 difference on a $240,000 home, that's a 16% change. So what I'm getting at is this interest rate alone would cost, theoretically, from a payment perspective, almost a 16% change. It does vary by price of the house. In addition to that, you've got this low supply. So you've just got everything pointing to a seller's market right now.
Well, so I'm, again, for our YouTube audience, this you're seeing right now, I'm sharing the screen again from the St. Louis Fed, the Federal Reserve Bank of St. Louis, or the St. Louis Fed. The graph here is the 30-year fixed rate mortgage average in the United States. And this series is going all the way back to 1970. It was at 7.5% there. It climbed in the 1982 effort by Paul Volcker and the Federal Reserve to tamp down inflation. It went up into about the 18.5% area, and it's just been a steady, ebbing, seesawing back and forth, but just steadily declining. So that here on the right-hand side, as of December 10th, so they issue this on Thursdays. December 10th is now 2.71 nationally, and if we go to the 15-year, this is average. You can, if you have some better credit scores, or more down, or things of that nature, you can do a little better. But the average on a 15-year now is 2.26. So unbelievable that you can get these kinds of things. In fact, the rate I bought down my rate. My 15-year rate was 1.875, and I was about probably 3 weeks early. If I'd gone back to the same lender for a half a point, I could have bought it down to 1 5/8, 1.625. So it is, even though these are the averages, there are still lenders that are making even these rates look like they're confiscatory instead of really as rock bottom as they can be.
Yeah, and these rates can really make a strong impact on someone's financial plan right now. So it is a cost-saving aspect to it as well. Or on the other hand, if you do own a home, you could see an increase in price as well. So all this really does translate over to people's overall financial picture, what their retirement looks like. And when it comes to making decisions, it's also an extremely important element of it.
Mm-hmm.
And even just at a higher level, conceptually speaking, doesn't it seem a little bit crazy that anyone would give you a loan for anything over 15 years for, like, would you 1.875? What was the number that you got? Yeah, that just seems crazy to me when you consider that a year ago you could have gotten similar rates. It would have been lower, but similar rates in a money market account.
Mm-hmm.
Right.
Yeah,
so it's just crazy to me that
right.
Yeah. So it sounds like you made a really good mortgage move there, Eric, getting a really good rate. That's
I got to say,
wonderful.
as the frugal advisor that I am, and you are too, it's just like it sent a little thrill up my spine when I saw the
Yeah.
number that we would get.
Yeah, I'd only heard of a similar rate years ago from someone who got who was able to work some kind of deal where their mortgage was tied to yen and Japanese interest rates. I can't believe
Really?
in the United States you're getting rates like that. Yeah, that is a little crazy, but that's a great job, Eric. And anyone else that's refinanced out there, you've probably gotten a really good deal as well.
Yeah.
So let's continue this conversation then. Let's say I'm a buyer. Interest
Mhm.
rates are low, which is a good time for me to buy, but it's a seller's market,
Mhm.
right? So what do I do? How can I use some of this information to make a decision? Would you, Eric, if you were out there as just a buyer, let's say you're renting right now, so you're not involved on two sides of
Mhm.
the transaction, would you go out there and buy, or would you? It's time to renew your lease, right? Would you say, all right, I'm renewing for 6 months, for a year, or would you say, all right, no, I'm going to go buy right now?
Well, the individual circumstances, of course, are going to dictate this, very strongly. If you have something that's a trigger of that kind, you might say, I'm not going to stretch this out. I'm not going to renew my lease. This is just too opportune. Even though I might pay more, I anticipate living in whatever place I purchase for the foreseeable future. And so I'm willing to go ahead. And even if I'm paying more for the house, and by the way, that was our reasoning, and we might be looking at this a year or two from now and saying, we're kind of underwater on this house, or at least we paid more than the house is then valued for. We won't be underwater because we have a lot of equity in it. But the point being is that you might just say, hey, I'm going to do this because I'm going to be here for a while. And with these interest rates, of course, there's a strong motivation to consider that. But I would say just be prepared for a couple of things. Number one, line up your finances beforehand. Get that all set to go so that you're pre-approved, not just pre-qualified, so that you really can move on an offer, because the seller is not only looking at the number that you're bringing in terms of the nominal price you're saying you're willing to pay, but also how strong are you coming with cash, and are you approved? So that's one. Number two, be prepared when you see something that you like to get out and see it and be ready to make an offer. So have developed a sense of your actual preferences for things, so that you're not dilly-dallying and saying, is this really where we want to live? It's good if you can have given clear thought to that beforehand, so that when you see what's there, you're prepared within its 24 hours of its being listed to see it and make an offer if necessary. I think that's not going to be true in every area of the country. And the same source that I cited slightly earlier ago, Realtor.com showed that the average listing time on the market now is 57 days. So, but I would say that's partly driven by the fact that some people elect to go, I would say they get a little greedy. They overprice it. And then what happens is it doesn't sell right away. Then that sends an adverse signal to other buyers that, why isn't this home selling right away? And then, especially if they then start responding to that delay with
Well,
price
Eric, I'm going to
cuts.
stop you. I'm going to stop you for a second.
Mm-hmm.
I'm bringing you back to my question.
Mm-hmm.
If you're a buy, because you're talking about being prepared to buy, all good points, but I
Right.
want to take
Mm-hmm.
us back to the starting
Okay.
point. If you're a buyer right now,
Mm-hmm.
and you have the option to renew your lease and stay rented, let's take let's look at it purely as a good time or bad time, right? And I know nothing's
Okay.
exact, nothing's
Mm-hmm.
definitive, because if you're a buyer right now, would you say, hey, renew the lease, or would you say, hey, go buy the property? Or another way to ask the same question, do you think property prices are likely to come down where that buyer should wait and see if they come down? Or do you think they're going to continue to go up where that buyer should go jump in as quick as possible?
Okay, well, so that's a different question. So I did preface it by saying, if you anticipate being in that home for quite a number
Yeah,
of years, you might be able
agreed.
to just accept and suffer through the fact that for a period of time early in your extended ownership phase, you did see prices soften around you, your home's own evaluation included, but you don't really care because that's not why you're in it for the long haul, and you got a great interest rate, and so in terms of your actual cost to purchase it, you're not feeling like it's the worst thing that ever happened to you. But I would say, if you're thinking, no, I'm probably not going to be there more than 5 or 7 years, here's speculation. I'm going to speculate about this, and you guys can disagree. This is, maybe we get into some controversy. So I think it's possible, not certain, but possible, that once we have widespread vaccines, that a lot of people are going to start rethinking and are going to start feeling more mobile, including owners of existing places, and some people who have been reluctant to have someone who's a stranger come into their home, or let alone a lot of strangers come into their home to see it if they list it, will now feel like, hey, that's not really a concern of mine. I don't mind. I've gotten a vaccine. I'm okay. Come on in. I don't, come on in. And I believe that could contribute to opening up the supply substantially, so that you could see a lot more homes coming back on the market. On top of that, we have been, in a moratorium on foreclosures and on evictions, and now that moratorium has come to an end. Now it could be extended. But with that, it's conceivable that you'll have some properties during this period with so many people who've lost jobs or businesses unable to continue to make payments on their homes, and therefore foreclosures affecting them. And as a result, that also could contribute to supply. So I wouldn't be surprised, I'm not saying with certainty, but I wouldn't be surprised if 6 months or 12 months from now, we saw a pretty substantial softening of prices again. I have to say, though, that in what I just said, the National Association of Realtors, so they have it's realtor.org, different than the realtor.com that I cited earlier. They have a lot of really interesting statistical information on their website, and including a presentation that was released just yesterday. And so I'll just point this out on my screen here, that this study called the 2020 Real Estate Forecast Summit, which was held yesterday as we're recording this on the 11th of December, has page after page. We're talking about 21 pages of graphs telling us where we are and what they're anticipating will come about soon. And their forecast is that in 2021, you'll see another increase in valuations, and then but diminishing from what you've seen so far this year, and then still another year after that, valuations will continue to rise, although again even less than that subsequent year. So they're not sharing the view that there's this imminent supply coming in that's going to suddenly send prices downward, let alone spiraling downward. But you asked for a perspective, and there's one possible perspective.
So I don't think anything's going to spiral down as well. But I do think a couple of the things you mentioned, which when you talked about people coming into the home, that's sort of supply, that properties that would have been on the market now that have just been delayed. So I think supply will have to increase because of that. In addition to that, this foreclosure moratorium that you mentioned, what that is that's a moratorium on foreclosures by the Federal Housing Finance Agency, and they've extended it a couple times. As of right now, it's extended till January 31st, which means that banks cannot foreclose on homes until then. So I've read a lot and seen a lot about how there's going to be a lot of banks that will put homes into foreclosure around that time frame, or at least starting the process. And in some states, they've already started the process. They can't just fully execute on it. So you've got the fact that there's some people that want to sell their home but haven't been able to, or haven't felt safe to put it on the market, and for whatever reason, once they feel safe, they'll put it out there to sell. And second, you've got the foreclosure. So I don't expect a spiral decline. I just think that if you have the ability to wait a few months, at least to let things settle out, it may work out to be a profitable decision for you. in addition to that, the other thing driving the housing market right now are low interest rates, and I don't see interest rates get shooting up anytime soon either. So um, when you mentioned at the beginning of this question, I really liked what you mentioned about time frame, because I think with any major purchase or investment decision, your
Mm-hmm.
time frame is very important in deciding this. So if you're thinking, hey, I'm going to buy this house that I'm going to live in forever, it might go down a little bit before before it goes back up, but you're very unlikely to lose money on that um, property 15, 30 years down the road. But in the
Mm-hmm.
next 3 to 5 years, you might find yourself negative. The same kind of thing with the purchase. If you're only going to live in the house for about 5 years, let's say, it may it would that would give you more reason to wait versus someone who says, hey, I'm going to live in this house for the next 30 years.
Mm-hmm. Yeah, I agree with that very, very much. And I do also want to just hasten to add that this is to a large extent localized. And so we're
Yes.
making these statements about things at a very sweeping level, but indeed it is localized. So for our YouTube audience, rather than just our podcast audience, this same study that I was mentioning was produced just yesterday. I want to show you two other infographics. So here is what the National Association of Realtors is saying are the top prospective markets in a post-COVID phase of 2021 and 2022, and you can see that these are scattered about. There, you do have, of the major metropolitan areas here, you have the Phoenix, Mesa, Chandler area, as well as the Dallas Fort Worth one, and I would then argue also, I guess, Indy and Carmel, Anderson, Indiana, and Charleston and North Charleston, South Carolina. But some of the other places are, well, cities, they're not exactly, killing it in terms of huge populations. So what they're thinking is that Phoenix is going to lead the way with a 10% increase in pricing in 2021. Austin at 9, Charlotte at 8, Atlanta at 7, Houston at 7. So and so forth and so on down the line to Boise at 3. But if these are the top prospective markets, and we're looking at 12 or 13 of them here, then other MSAs apparently then won't see a 3%, as much as a 3% increase in pricing year on year, given their consensus about the top prospective markets is indeed correct. So again, point being, it's localized. And if you're in Phoenix and you own something, buckle up, because you're probably going to see your house appreciate still further in a hurry.
Yeah, I like not only the point that you mentioned, it's localized with the real estate, but also like in this bottom market of Boise, I'm sure
Mm-hmm.
you can find a really good deal there where
Mm-hmm.
it'll appreciate by like maybe that
Yes,
Phoenix type number, right? There are
true.
always deals to be had.
Yes, so
And I think
true.
that's kind of gets to the point of that when I first asked the question of if you're buying or you're thinking about renting versus buying, extend your lease or should you buy, it
Mm-hmm.
really starts with the deal you're getting, right? If you're getting a good deal, just because the markets are appreciating, if you're getting a good price, make the move, right? On the flip side, if it's appreciating like crazy and you think you're overpaying, that's when that time frame becomes so important.
Yeah, that's really true. I want to show you there is for data hounds, there are some really great resources out there that will allow you to pull down some data, and if you're handy with a spreadsheet, you can see a lot of these sorts of things. So Zillow has a research component as well, and some downloadable data for something like, I think it's 900 different MSAs in the United States. And so what I did is I took some that were of interest to me. First of all, I took large ones, but then I also have clients in Seattle, San Diego, Denver, Grand Rapids, and then Rockford's near me, and Holland is where Holland MSA is where we're moving. And what you can see by all these lines that I've graphed, this is going back to 1996, and then how prices using 2000 numbers. Well, these are actual home value prices. What do you see on the far right side? Well, you see essentially from about early 2019 mid 2019, something like that. It sort of stabilized for a bit, maybe a little bit of a dip, and then it was off to the races. And the pace of increase in here is about as steep as you've seen since things started coming out of the bottoming process in 2012. And, so in particular, if you look right here at this one, the Seattle market, it's just almost, I wouldn't say parabolic, but it's getting there.
Yes.
So it's really interesting. We have up on the top here, you have the LA area, then you have San Diego, then you have Seattle and some others in here. So, just the data we'll again have in the show notes if you want to see some of these links. This is the research arm of Zillow, and I appreciate their generosity with all of this. But you could isolate the one MSA that might be of interest to you, both either from a selling or a purchasing standpoint, and do a little comparison like this. And if you want to ask us for this spreadsheet because you don't know how to build a graph like this, then I will happily send this to you. Just you've got our contact information in the show notes.
Yep. Excellent. Now I want to continue our conversation and say, how do I use this information now if I'm an investor?
Mm-hmm.
So Eric, and let's actually, because you had brought up the time frame, let's split this up and let's say, okay, I'm someone who wants to buy a property and rent it.
Mm-hmm.
Does it seem like a good time to be a buyer in this space in general, right? Taking out the fact that it's all local, using some of the national numbers. If you're someone who wants to buy a property and rent it, do you go out there if you're getting the average price right now and say, okay, let's make the move and take advantage of low interest rates? Or do you wait and say, well, I think things will stabilize or even come down a little bit and I can get a better deal on this rental property later?
That's a great question, and I don't have a firm conviction about that because I think it's also is parallel to the study that we've been doing here on home selling and home purchasing. We need to really look closely at the dynamics of what's been taking place as well with rental rates. So, and what rental supply and rental demand, rental pricing, and so forth. My sense is that if you're looking for housing that's probably in the, let's say, the 200s, the sub $300,000 level, and particularly depending on where you live, this is affected, of course, by where you live. But if you're looking at buying something to rent that is less than $300,000, you'll probably be able to say, hey, the mortgage rate I'm getting on this one is just so incredible that it's hard not to want to buy that and rent it out. I would say that because you're just every single payment that you're receiving from your renter is going towards your mortgage, and you're building equity pretty quickly that way. Whereas in a high interest rate environment, that's not as true. So, that's just but I would say it depends again on the market, and it depends on the price of the home.
Yeah. So,
How about you?
and I think that question I asked you was a little unfair, right? In the sense that you have to look at what will that rental income support the mortgage, right?
Mm-hmm.
So, are you going to be net negative or net positive on a cash flow basis per month? And so, is it worthwhile? If you think from that perspective as a longer term investor, my thought is that barring getting a really good deal, the argument to wait at least a few months is pretty strong there, just because of increased supply and increased supply from more sellers in general, and from that foreclosure moratorium being lifted. That to me is an argument to wait a few months at least to see how things settle out, maybe even a little longer. Now, on the flip side, though, the other type of real estate investor that is out there is usually someone who flips properties. They'll go out and do a quick renovation and sell. That's their, as opposed to buying the property to rent and collect rental income. They're buying a property that they're going to do some type of value add to, some type of upgrades and renovations, and then sell it pretty quickly. For that person, I think the argument to wait is not as strong because they're likely buying and selling in a seller's market, since those
Mm-hmm.
transactions usually happen faster. That's
Mm-hmm.
why I separate the two out. Now, they could
Yeah.
wait a couple months as well just to see what would happen, but I think the impact for them is it's unlikely for them to, because their holding period is so much shorter, they're probably not going to be buying into in a strong market and selling into a soft one.
Right. Yeah, I do. Yeah, I agree with what you've just said. I think whenever I think real estate has to be understood, whether it's as a residence for yourself or as a rental, you're purchasing as an investment property. Pretty much your outcome is determined for the most part on the front end. What are you able to buy it for?
Yeah.
And if you are overpaying, you might justify that if it's really the quote unquote home of your dreams. And honestly, the reason we were willing to, what I would say, is overpay. I mean, I honestly believe we're buying this for probably at, even the most favorable assumption about what it's probably going to be worth in a year. We're probably about 20,000 over that. So, which is, okay, because when I just look at how my wife responded to the home at an emotional level, it makes me happy as a husband to see how happy she is. Happy wife, happy life, that principle. So, it's worth it to me. But if I were doing it as an investment property, I would say we really made an error in that particular purchase. I was actually contemplating not selling our current place and instead renting it out.
Mm-hmm.
But the math worked a lot better here, rental rates here compared to purchase or sale prices here, than it worked out on the other side of Lake Michigan. So I was thinking about it, and I thought, if we leave X amount of equity in the home and then rented for this rate, then I think we would see a good solid 10% return annually or better on our equity. Which for me would be sort of like the minimal necessary level to do after all of the expenses and the hassle of being essentially a landlord at that point. But at the new higher price that we were able to get for it, it changed the math on that. And so now the yield, if you will, from selling versus hanging on to the property and not realizing that current price gain, just didn't seem like, the math didn't add up any longer. So what we would forfeit, the opportunity we would forfeit by not selling, we couldn't really recover it as strongly as I would want if we had gone the rental route instead.
Interesting. And I'm not surprised that you ran that analysis at all.
Well, yeah, it's important to really, like you said, Eric, to really work through the numbers. And I think this is an interesting topic that you brought up, Roshan, because it is a potentially great cash flow opportunity, and it also helps maybe diversify your portfolio as well. Just adding real estate to, if you're very heavily into stocks and bonds, this is just another way to help diversify your financial picture. And the way rates are right now, it kind of adds on top of it a little bit more on whether or not you should make this decision or things to consider. But yeah, working through the numbers, considering whether you'll have vacancies or not, if you'll be able to support it and build up equity, is all important points to it.
Yeah, you definitely need to look into everything, and then make an informed decision. And sometimes you'll look into everything and say, well, the numbers look a little bit better here, but I prefer doing this. But I think making that decision with the information is very different than just falling into something.
Mm-hmm.
Eric, one thing you said earlier when you were describing the property, is that a lot of your investment performance is essentially determined at purchase point. I
Yes.
think Benjamin Graham had a quote around that as well. And it lines up to what we're talking about today very much so, right? If your outcome is going to be determined at purchase point, that means basically whether your investment does well or not depends on how much you paid for it at the beginning. You can overpay or underpay,
Right.
make sure you get a good deal up front.
Right.
And I think that falls right in line with our conversation today of the real estate market. Is it a buyer versus seller's market? We talked about it definitely being a seller's market, and gave you some ideas to the listener, gave you some ideas on things to consider when you're making that purchase.
Yes.
Uh, Erik and Adrian, do either of you have any last minute, any parting advice for or ideas, thoughts for our listeners?
Well, I'm just going to say in the show notes, we have, I'm going to be providing you with a bunch of links to research sources, both governmental as well as private sources. And so if you're a data-driven person and you want to see some of these things, and you're helped by graphs in particular, you don't have to create all the graphs, although if you're adept with a spreadsheet and a data set to be able to turn that into information that you can see, so much the better for you. But do go to the show notes and pursue some of this research if this is of interest to you. And again, if you have any sort of questions, do reach out to us. I mean, Roshan and Adrian are there in the Northern Virginia area in Vienna, Virginia. I'm here now with a couple of locations in Northern Illinois, Crystal Lake specifically, and then West Michigan in Zeeland specifically. So we're happy to entertain your questions and have a conversation with you.
Yeah, and Erik, you mentioned where we are, but especially in the pandemic era, it's just shown
Right.
how where you are doesn't matter. I know,
Right.
I know we all, we work with clients all over the country.
Yes.
So anyone that needs help, please give us a call, send us an email. All of our contact information in the show notes. And to all our listeners, once again, as I always say, thank you for listening. Thank you for joining us. We hope you found this helpful and that this gave you some thoughts and ideas to make a better decision in the real estate space. And we hope that we always help you make better decisions in your overall financial life. This has been another episode of the Retirement Lifestyle Show, and we'll be back to you next week.